Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Friday. It's Friday, the 9th of April. It's the last day of the second trading week of April of 2021, and God only knows where this year has gone. I'm still trying to figure out where 2020 has gone. Let's talk about global economy. There was a lot of reports today. A lot of news to report today, so I wanted to just cut out the most important stuff instead of just scrolling down through the whole page. I figured I'll just give you the highlights. So Chinese markets, those Chinese, we got to watch those rascals. They reported stronger than expected rise that could prompt authorities that could cool inflation. This is very interesting. Chinese reported that consumer prices rose in March due to a jump in fuel prices, while producers' price climbed at the fastest pace in more than 4 years. Now, we got to take Chinese data with a grain of salt. We don't really know how honest they are, but this is very, very impressive. Consumer prices rose 0.4% in March compared to minus 2% in February, as fuel prices jumped nearly 12% from a year earlier. Prices paid by manufacturers rose 4.4% from a year earlier. That seems to be very inflationary, if you ask me. Inflation reflects rising demand as Chinese economy leads the world recovery from the pandemic. That's something. Worries that stronger growth might spur inflation that regulators in many major economies would then move to cool by raising interest rates have been overhanging the markets for the last several months. That's one of the reasons why U.S. tech stocks have been so vulnerable, to say the least. Added to that, fresh round of U.S. sanctions, this time against 7 Chinese supercomputer makers, have revived concerns that there's friction between U.S. and China. Now, going back to the U.S. stock market, pullback in yield, this is U.S. yield, put some pressure off tech stocks, which have slipped over the last few months. That's what I'm talking about, the technology sector, making shares look more pricier. The sector has been choppy trading since investors have been shifting more monies into companies that stand to benefit from the economic recovery. Infrastructure stock, basic material stocks, financial stocks, boring stocks, not the kind of stocks we liked last year. Investors are showing cautious optimism about the economic recovery, especially in the U.S., where vaccination distribution is ramping up. Biden's now talking about April 19th to make doses available for everyone. And everyone I talk to now pretty much has a chance to either sign up for vaccines here or have gotten the vaccines, but it's making its way now. It's got a long ways to go, but the number of Americans who filed unemployment last week rose again to mid 700,000. That's not a good indication, but it is what it is. We'll have to work with what we've got. But according to Jerome Powell, Mr. I'll tell you what I'm predicting 2 years in advance, it looks like we're going to start moving higher in terms of inflationary pressure, but Jerome Powell says no. But look at the long-term bond. I mean, look at this thing. So we may be kind of choppy for a while, but there is concern, and there's a good chance that this market will cool off again. Don't expect too much of an upside in the bond market. Expect mostly sideways, choppy action with some downside correction. Now, before the market's opening, vulnerability in the NASDAQ 100 today. The techs are cooler. Let's see. The bond market is cooler. I'm curious if the correlation between the bond market and tech has picked up again. We'll have to watch it closely. But the Dow's pretty strong. The S&P's doing pretty well. So it's just the NASDAQ right now. So not really a lot to look at. There's not a lot of trade, a lot of choppiness right now. A lot of it has to do with the bond market. We have to keep our eye on the bond market. I think by the end of the year, yield will go above 2%, which means the bond market will be closer to 1. Because we went from a yield of 0.93 when bonds were right around here, right in this area right here, and we went all the way to a yield of from like less than 1 to almost 2, 1.78, I think, up to here. And now it's, I think, at 1.65, 1.6, around that area. But I think we're going to go to 2.5, maybe 2.25 by the end of the year. But remember, we're only in the beginning, literally in the beginning, like the first week of the second quarter. So I think we're going to be choppy and move sideways, but I think the yield will move up on the bond. Remember, there's an inverse relationship between bonds and interest rate yield. So as bonds go down, yield on interest rates go up. So I'm talking about further downside pressure on the bond market. Choppiness and downside pressure. Don't expect too much upside. Fade those rallies, all right? Now, it's Friday. I don't want to keep you a long time here because it is Friday, and I'm sure you've got a lot of important things to do. Just want to take a quick look at the stock market and show you the fact that the S&P is showing no signs of cooling off. But again, remember, momentum, 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 and divergence. We're seeing divergence, and this divergence is still there, and we're overbought. There's a really, really good chance that the S&P is going to hit the 50-day moving average again in the very near term. Why am I so confident in that? Let me show you why I'm so confident in that. I'm so confident in that because right now the momentum levels in the S&P are at 93rd percentile. 93% of stocks out of the 500 stocks are trading above the 50-day moving average. And that, my friends, is an all-time high, at least the highest we've seen since we've been here. So I believe the stock market is going to be very, very vulnerable, and it's going to pull back, at least temporarily. It just can't keep going up at this rate without pulling back. And I know this may sound like a broken record at this point, but expect us to cool off, and it should take the Nasdaq down with us. Now, let me show you the strongest stocks in the S&P 500. I'll show you the weakest stocks in the S&P 500, and then I'll do the same thing for the Nasdaq and the Russell. So, Sherwin-Williams, one of my top stocks. Applied Materials, one of my top stocks. Kohl's, one of my top stocks. Alliance Data Systems, L Brands. Have you noticed a pattern that my relative strength scan has had these guys on their top list for God knows how long now? L Brands, retail. Coach, retail. Sherwin-Williams, basic materials. What have I been talking about? Gap, Nordstrom's, Coach, L Brands, Kohl's, chips, energy to a lesser degree, and retail. That's the focus right now. Energy, retail, and chips. Now, if you're looking at the weakest on the S&P 500, you've got pharmaceuticals. They're not doing really that great right now. Pharmaceuticals, kind of mixed bag, if you will, a little bit of everything, which is kind of, not that unexpected, but nothing really great. A lot of the stay-at-home stocks like Clorox, Charter Communication, Regeneron, it's a mixed bag. A lot of pharmaceuticals and a lot of the cloud stocks like Salesforce, VeriSign, a lot of the internet security stocks, a lot of the cloud stocks, a lot of the pharmaceutical stocks. Basically, everything that was making new highs, or most stocks that were making new highs a year ago, are now in the crapper. Now, let's look at the NASDAQ 100. That's the S&P. If you look at the NASDAQ, you will see chip stocks. Look, Applied Material, chip stock, chip stock, chip stock. Data storage, Western Digital, hard drives, chip stocks, travel stock, chip stocks. But you could see that chip stocks are grossly dominating the NASDAQ 100. And on the downside, look at this. This is like, do you remember Zoom a year ago? Do you remember SGen a year ago? Do you remember Splunk a year ago? Do you remember Verisk a year ago? VeriSign, JD, Lululemon? All of the stay-at-home stocks, all the stocks that were doing really great are in the toilet now. Now, let's do the same thing for the Russell 2000, which is a little mixed. You've got GameStop, you've got Silvergate, you've got Prime Therapeutics, you've got a lot of pharmaceutical stocks, a lot of game stocks, a lot of different type of stocks in the Russell. But these are the top stocks. Top 5, OAS, GME, ACRS, SI, Silvergate, and FPRX, and SM Energy. On the downside, the weakest Russell stocks, ODT, FREQ, ACAD, FGen, and CNCE. Pharmaceuticals. A lot of pharmaceutical stocks are taking a big breather right now. As a matter of fact, if you look at my top sectors, you will see that healthcare is last to consumer staples. So healthcare stocks, if you see a good rally on a short-term downside healthcare stock, that's a good stock to short right now. Healthcare stocks are not doing well right now at all. Financial, energy, industrial. And if you do look into tech, try to be in the chips, not in the cloud storage. That's not where the money is. Now, before I let you go, before you have a great weekend, I've got something important to tell you, something timely, something you need to pay attention to. What if I said that everyday traders could win in the markets, even when they're wrong about the direction of a stock? Yes, you've heard me right. Make money in the stock market, even if you're wrong about the direction of the stock. Wall Street legend, 10-time heavyweight trading champion Chuck Hughes, he just discovered a trading strategy that's so powerful, he's been able to signal winner after winner after winner. 96.3 historic win rate. Can you imagine? Regardless if the market goes up, down, or sideways. Even when the stock market moves against him, 96.3% win rate. Amazing. Now Chuck is finally revealing to the world what he's found and how anyone can start using this strategy to pull potential profits today, right now, immediately. We launched this sucker like a month ago. He's had 2 triple-digit winners already. Chuck, you got to watch this guy. This guy knows what he's doing. Again, Chuck is finally revealing to the world what he's found and how anyone can start using the strategy to pull potential profits today. 96.3% success rate. Make money up, down, sideways market, regardless. If you're right, you still make money. Man, I love making money even if you're wrong in market direction. And you know what the best part is? You don't need a big account and it's IRA friendly. Folks, it's time to do it. Click the link below. Access Chuck's latest trading breakthrough. Do it now. Do it before it's offline. Have a great weekend. Make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Be the first to subscribe. Be the first to be notified when we post our new video. And send me some comments. I want to hear some comments. All right, you guys have a great weekend. Click on the link below. Check out what Chuck's discovered. Make money, 96.3% historic win rate. Make money in the up, down, and sideways market. You cannot afford to miss this out. When Chuck showed this to me, really, the hair on the back of my neck stood up. I loved this. This was very, very cool, especially in the choppy, range-bound market we're seeing now. Follow the link below. Access Chuck's trading breakthrough now. Have a great weekend. Bye, guys.